the liquefaction and the exportation of U.S. natural gas resources is a work in progress. In the meantime, however, the domestic natural gas glut continues. Further, news of a gas pipeline running from Russia to China is being viewed by traders as future demand destruction for U.S. fracked gas. Of course, the weak fundamental landscape is probably being irrationally exaggerated by thin holiday trading volume. Nevertheless, the long liquidation in natural gas might not be over. Retail traders are generally surprised to learn that natural gas prices actually tend to soften in November and December. However, in some years, we see a sharp November rally based on weather concerns prior to that weakness. This is because end users typically purchase natural gas in advance of the winter season, causing prices to firm up. But as the winter progresses, prices decline unless an unexpected weather event causes excessive consumption of the energy. Looking at the chart provided to us by MRCI, that's Moore Research Center Incorporated, natural gas seasonals on a 15-year basis tend to see a couple of weather spikes in the late fall, early winter, but we can see the overall direction is lower. In fact, the weakness tends to extend all the way into late December. We also like to look at the Commitment of Traders report, which is issued by the CFTC, the Commodity Futures Trading Commission. This gives us a glimpse into which type of trader, whether it's large or small speculators or hedgers, are holding what type of position. Are they net long? Are they net short? And to what degree? Currently, the large speculator, who is considered to be the smart money because they're trading large accounts and sizable positions, they're net short natural gas futures. However, they aren't holding the aggressive short positions they were earlier in the year. Specifically, this group of traders is holding roughly 140,000 net short contracts. This can be compared to 212 net short contracts being held a few months ago. In our view, this gives us an idea that there could be additional selling. In other words, there's room for additional selling. Traders haven't used up all of their resources when it comes to the short side of natural gas. Further, those who are long natural gas are probably feeling the pain. Thus, they may start to rethink their position and could be spooked into continued liquidation. We see a similar picture when we look at the weekly chart of natural gas. In my view, it depicts a market that has room to move on the downside. Long-term trendline support doesn't come in until we see $2 in natural gas. Additionally, the Relative Strength Index, or the RSI, is pointing decisively lower, and it has plenty of room for prices to weaken before that indicator becomes oversold. We've also noticed that this year's attempt at a November rally was dismal. We did get a rally, but it was short-lived, and it reversed quickly. This is unlike others we saw in 2016 and 2018, which were much more bigger and longer lasting. This could discourage bulls and eventually lead to a retest of the lows or even a little lower before the market has a good chance of finding any sort of stable footing. We always remind our followers that natural gas is a trader's market, and the most explosive moves come to those on the bull side of the market from discounted levels. Accordingly, we're not suggesting that anybody attempt to short natural gas. In fact, that's the opposite of what we're suggesting. All we're saying is, if you're bullish natural gas, be prepared for a potential move to $2 before getting in, or at least save some ammo for those levels. If you're in the unfortunate position of being long natural gas, hedges are important. Things will probably get a little worse before they get better.